Welcome. This is Forex Essentials, a beginner's guide to Forex trading, prepared by Cruise Institute. Forex Market Basics. Introduction to Foreign Exchange Market Basics. Foreign exchange market, as commonly known, FX or Forex, is a global, decentralized market where currencies are traded over the counter. We have 24-hour trading in Forex trading. The Forex operates 24 hours a day, 5 days a week, Monday to Friday, thanks to the participation of a global network of banks operating in different time zones. There is broad participation. Anyone can participate in Forex trading, from individual retail traders to large institutional investors as well as central banks. There are low barrier entries to Forex trading. Opening a Forex trading account requires only a small deposit, and most brokers offer leverage that allows traders to control larger positions with a small amount of capital. There's also high liquidity. The Forex market is highly liquid. With the high volume of transactions and large number of participants, this means that traders can quickly enter and exit position at fair market price without slippage or recoats. We move on. So the Forex market allows traders to speculate on price movements of currency pairs such as the Euro USD, GBP USD, as well as the USD JPY, amongst many more. Traders can profit both from rising and falling exchange rates by buying or selling specific currency pairs. Currency prices are influenced by a wide range of economic, political, and social factors such as interest rates, inflation, GDP, gross domestic product, geopolitical events, and market sentiment. Forex trading is a complex and dynamic market, and traders should and need to have a good understanding of market mechanics, risks, as well as trading strategies before investing any capital. Understanding currency pairs. So in Forex trading, currencies are always traded in pairs. A currency pair is a quotation of the relative value of one currency against another. The first currency pair is always known as the base, and the second currency is known as the quote or the counter currency. For example, in the currency pair Euro USD, the base currency is the euro, and the quoted currency or the counter currency is the US dollar. This means that for 1 euro, it can be exchanged for a certain amount of US dollars, which in this case, let's take for instance, the exchange rate is 1.1200. This means that 1 euro is worth $1 and a couple of pennies. The price of a currency pair is determined by the supply and demand for each currency in the pair. If there is a higher demand for the base currency, its value increases and the exchange rate will rise. And if there's a higher demand for the quote currency, its value increases and the exchange rate falls. There are three types of currency pairs. We have what we call major pairs, minor pairs, and exotic pairs. The difference between these is that a major pair is the most frequently traded currency pairs, which includes the USD, the Euro, the Japanese yen, the Great Britain pound, the Swiss franc, the Canadian dollar, the Australian dollar, as well as the New Zealand dollar. In minor pairs, these pairs do not include the US dollars, and these are also known as cross currency pairs. For examples, they include the GBP pound and the euro, as well as the Canadian dollar and the Japanese yen. Exotic pairs are pairs that include one major currency and one currency from an emerging economy or a less developed economy. Examples include the USD and the Turkish lira, as well as the euro and the ZAR, which is South African rands. So understanding currency pairs is important to forex trader, as this helps us to analyze market trends, to develop trading strategies as well as make informed trading decisions. Traders need to consider the economic indicators and events that affect each and every currency pair and how they will impact the exchange rate. Types of forex markets. So there are different types of forex markets that operate globally, each with its own unique features as well as characteristics. These markets, namely, are the spot market, which is the most commonly known forex market type, where currencies are traded for keyword immediate delivery or 2 business days, T plus 2, after the transaction takes place. This type of market involves a direct exchange of currencies between two parties, with the exchange rate being determined by the market forces of supply and demand. The next type of market is a forward market. This involves the sale and purchase of currencies for delivery at a specific date in the future. So the exchange rate for the transaction is determined at the time of the trade, but the physical exchange of currencies takes place at a future date specified in the contract. So this market is popular among businesses as well as investors, high net worth individuals that want to hedge against currency risks in fluctuation currency risk. We move on. Another certain types is a futures market. The futures market involves trading standardized contracts for the purchase or sale of a specific currency at a fixed future date and price. Futures contracts are traded on regulated exchanges and are usually settled in cash on the delivery date specified in the contract. This type of market is popular among speculators looking to profit from price movements in the currency market. And lastly, we have an options market. The options market involves the purchase of the right, but not the obligation to buy or sell a specific currency at a specific price and date in the future. Options can be used to hedge against currency risk or to speculate on future exchange rate movements. So, this market is popular among traders and investors who want to limit their risk exposure while still being able to profit from currency trading. In conclusion, the forex market offers different types of markets to meet the needs of various traders and investors. These markets provide opportunities for arbitrage and speculation, as well as hedging against currency risk associated with international trade and investments. Market participants. So, as we have mentioned, the forex market is a decentralized market, which means it does not have a physical location or a central exchange. Instead, it operates electronically through a network of traders, banks, and financial institutions. So, there are four main categories of market participants in the forex market. We have central banks, which play a crucial role in the forex market. They are responsible for implementing monetary policy in their respective countries. This involves adjusting of interest rates and managing the money supply in an economy. Central banks also intervene in the forex market to stabilize their country's currency exchange rate. We also have commercial banks. These are the most active players in the forex market. They facilitate foreign exchange transaction on behalf of their clients, which includes importers, exporters, as well as investors. Commercial banks also engage in currency speculation and can influence exchange rates through their trading activities. We have non-bank financial institutions. With non-bank financial institutions, we have what we call hedge funds, pension funds, and insurance companies. These are also active participants in the foreign exchange market. They trade currencies. They trade currencies to generate profits and can have a significant impact on interest rates or exchange rates. We have what we call retail traders, which retail traders refer to individuals who participate in the forex market through online trading platforms offered by brokers. Retail traders trade currencies to speculate on price movements and generate profit. They account for a significant portion of the daily trading volume in the foreign exchange market. In conclusion, the foreign exchange market is a complex network of different types of participants, each with their own motivations as well as goals. Understanding the behavior of these participants is essential to analyze market trends, to develop your trading strategies, as well as make informed trading decisions. Market hours and trading sessions. The forex market, as we have mentioned, is open 24 hours a day, 5 days a week, providing traders with ample opportunities to trade currencies. However, the market is not equally active throughout the day. The forex market operates in three major trading sessions. We have what we call the Asian session, the European session, as well as the American session. We have something to note, which is the American session overlaps the European session for a few hours in a day, which results in high level of trading liquidities during this period, or rather trading activity. This means there's high volumes and high liquidity for traders to take full opportunity. So while the forex market operates 24 hours a day, this does not mean that traders need to trade all day and or all night. Traders can choose the market hours that suit their trading style, their schedule, as well as they can consider their time zone to optimize their trading activity. Order types. Forex traders can use several order types to manage their positions, to reduce risks, as well as protect their profits. Here are some of the main order types we use in forex trading. We have what we call a market order. A market order is used to buy or sell a currency pair immediately at the best available price. Market orders execute quickly, but the price may differ slightly from the quoted price due to market volatility as well as liquidity. We have what we also call a limit order. This is used to buy or sell a currency pair at a specific price or better. It is placed to enter market at a favorable price by ensuring that the trader will not pay more to buy or sell at a particular pair. We have what we call a one cancels other order. An OCO allows traders to place two orders simultaneously. But if one order is executed, the other order is automatically cancelled. This is used to limit losses as well as lock in profits simultaneously. Risk management technique. We have what we also call a stop order. A stop order is used to limit our losses by closing a position when the market reaches a certain price level. A stop loss order is usually placed below the current market price to protect long positions from further losses and above the current market price to protect short selling. We have a trailing stop order, which is similar to a stop order, but it trails the price movement and it adjusts the stop loss level as the market price moves in the trader's favor. It can help lock in profits and limit our losses. We have what we call also a take profit order. This is used to lock in our profits by closing a position when a market reaches a certain price level. It is usually placed above the current market price for long positions and below the current market price for short positions. Thank you. This was it for Market Basics.